I want to kick off the conversation with the fact that the Fed has been waiting to see what the impact of tariffs will be on inflation over the summer months before charting a course forward on interest rates. And we got the first reading of that this week with the June CPI. We saw that tick up a tenth of a percentage point to 2.9%. That was up from 2.8% previously. Are you seeing any indication that tariffs are pushing up inflation now?
I think you saw it on goods. If you look at the core goods inflation, especially in some of the heavily imported stuff, you were getting a warning sign. I took some encouragement that the services and the housing parts of core inflation still remaining pretty tame. But to me, that all fits into the space of still wait and see what is to come. And it doesn't help that we're going to announce a new round of tariffs that are going to apply to domestic production, parts, components, copper, supplies. We're going to go back and revisit tariffs on Canada, tariffs on Europe. There is a sense in which we need some resolution that we can count on before we can fully understand what the impact of this is.
How does that new round of tariffs that have been announced, and we've seen the president send out letters stipulating what tariff rates could be. Of course, we could see some negotiations, but those tariff rates are anywhere from 20% to 50% on some of our largest trading partners. How does that change your outlook for inflation?
I mean, that's the dual problem is if we're making these announcements in a kind of a drip fashion, you can't just count on let's call it the economic theory of tariffs. Hey, it's a one-time increase in the price level. That's a transitory inflation shock that a central bank doesn't have to worry about. You can't really make that argument if it's not a one-time increase in the price level. That said, as I've been emphasizing, imported goods, which these tariff taxes apply to, are only 11% of GDP. So there is a sense in which if it will stay in the 11% lane, it doesn't have to have a big material impact on inflation overall. And what you're going to be nervous about are if the tariff announcements lead people to freak out and change their behavior, that jumps it out of its 11% lane. If you start applying them more and more to intermediate goods like parts and supplies and components, then it's raising domestic costs of production and it gets out of the 11% lane. Or if there's big retaliation, then again, it's getting out of its lane. We were getting some relief on all three of those fronts as we got some exceptions and where they were backing down and doing the negotiations. And I think we just have to hope that we back down on all three of those fronts again, because right now we're kind of ramping up on all three.
Yeah, Austan, you had said that the central bank could cut rates if we saw what you called, quote unquote, dirt come out of the air. Now that we're seeing more uncertainty and an increase perhaps on these tariff rates, is this more dirt or, if you will, mud being slung? Does this prolong the timetable to wait and see what to do with interest rates? Has this changed your timetable at all on interest rates and cutting rates?
I feel like it started as dust in the air, moved to dirt in the air. Now I'm going to have to start thinking about, is there such a thing as mud in the air? Or if the mud is in the air as it is getting on us? I think anything that makes it harder to figure out if we are on a path back to 2% inflation, anything like that is extending the timetable of when the rate cuts can happen. As you said, I have been of the view that before April 2nd, before Liberation Day, the dual mandate grounds of the Fed of just price stability and maximizing employment were looking pretty good. And it looked to me like we could afford to start cutting rates, and that rates, I was saying then 12 to 18 months from then, could be a fair bit below where they were. Now, it's been 3-4 months, so now maybe we're 9 to 15 months away. I still think if we can get that uncertainty out of there and we aren't off the path, if we are still on the way to 2% inflation, rates can come down. But we don't know if we're on the path to 2% inflation because we don't know on tariffs, on energy prices and geopolitics, and in a few different areas. We don't know until we know. We're going to have to wait and see what's happening in the data. If we get multiple more months of benign readings on inflation, I would be feeling more comfortable. If we start to see a ramp up on prices coupled with a ramp up and increasing the tariff rates, then we're going to just have to see how big an impact that has.
Given where we stand right now, though, Austan, do you still think that rate cuts are on the table in maybe the fall months of this year? Or are you looking more in sort of a hold pattern right now?
Well, Jen, I always say, I don't like tying our hands ahead of the meetings. I want to hear what my colleagues around the table have to say. I want to see all the data that come in between now and then. But it's the biggest table literally I've ever seen in my life there. You've seen it. And so everything is always on the table. I have no problem. And as I say, if we can get the dirt out of the air and it shows we're still on path back to 2% inflation, then I think for sure it's realistic that rates could come down. It's just that if it gets cloudier and cloudier, so you can't tell whether you're on that 2% rate, that's to me is a recipe for waiting.
Fed Governor Waller has said he's concerned about the job market, saying that only 74,000 private sector jobs were created last month. He called it stall speed, and he wants to cut rates on July 30th. I'm curious for your thoughts on that and whether you share his views on the job market.
Well, you know the rules of the FOMC. I express only views myself. I don't weigh in on what other people think or what the committee thinks. That said, just looking at the total net job creation for the month, we saw last year when there are big changes to the amount of immigration, that can be an unreliable indicator. We need to think seriously about what's the break-even level of employment. I do still have concerns about the job market side. And if we were to start seeing, for example, significant layoffs, when the business cycle normally turns to recession, you start to see layoffs increasing. You start to see the unemployment rate going up at a not small clip. If we start seeing deterioration of the labor market, then that would be a major factor in my thinking.
The president's allies and advisors have been trying to paint Fed Chair Jay Powell's comments to Congress on renovations of the Federal Reserve's headquarters and buildings here in Washington as untruthful as they try to push him out because he hasn't been cutting interest rates. The president himself told reporters this is sort of a fireable offense, only to turn around and say that he has no intention of firing the Fed chair. We've heard from CEOs of major banks like JP Morgan and Goldman Sachs who've said the independence of the Federal Reserve is absolutely critical. Playing around with the Fed could often lead to adverse consequences. Is this campaign undermining the credibility of Fed Chair Jay Powell and the institution of the Federal Reserve and public support for the Federal Reserve? Do you worry that this is damaging and a potential threat to Fed independence?
Look, Jay Powell's a friend of mine. He's a totally honorable guy, and I'm a big admirer of his as the Fed chair. I think he's a first ballot Hall of Famer. I'm not going to get into the politics. I'll just say I've been in the Fed for 2.5 years. Before I ever got to the Fed, I, as well as a virtual unanimity of economists, believe that central bank independence from political interference is absolutely critical to the operation of the Fed and of the economy. That if you just look at places where they do not have independence for the central bank, inflation is higher, growth is worse, unemployment and the job market do worse. And everyone knows that. That's why every rich country of the world has an independent central bank. And as I say, it pains me to hear people actively discussing whether the central bank should be independent. I think it's nothing good can come of discussion like that.